Welcome to the Rob Berger Show, and welcome back to our continuing series on the Morningstar User Guide. It's a series of videos and podcasts that I'm putting together to walk through how to get the most out of Morningstar. This is video number 2 in our series. If you're listening to the podcast, you can find the videos by going to robberger.com/YouTube. Takes you to the YouTube channel. If you're listening and watching on YouTube and you want the podcast, just go to robberger.com/podcast. Today we're looking at the quote section for mutual funds, and we're going to touch a little bit on ETFs. I've pulled up as our example today information on the Vanguard 500 Index Admiral Shares Fund. Its ticker is VFIAX. And just as a reminder, the way I got to this page was just went to the search box up here and typed in the ticker, and it'll bring up the fund and it'll bring you to this page. You can see that across the top there are tabs. We're on the quote tab, but there's also fund analysis, performance, risk, price, portfolio, people, and parent. We will be looking at all of those in varying degrees. One thing I'll point out, and let me just actually do a search for a stock as opposed to a fund. Let's do Apple. You'll notice if you look at an individual stock, the tabs change quite significantly, as does the information on this page. So what I'm going to do is focus for now on mutual funds and to a lesser extent ETFs. And then later in the series, I'm going to come back and effectively do this all over again, but with a focus on stocks. And the reason I decided to do it that way is because the information on individual stocks is just significantly different and more detailed. And so I thought I'd separate that out. So we're going to focus on mutual funds, and as I said, touch on ETFs as well. And for today's episode, looking at the Vanguard 500 Index Admiral Shares Fund, VFIAX, and covering this quote page. And actually, you can get a wealth of information just from this page and very quickly. So I want to spend some time, though, and walk through what each data point means and why it might be relevant. And we'll start here with the NAV, N-A-V. That stands for net asset value. And you could think of this as the mutual fund's share price, just like a stock has a price per share. Well, so does a mutual fund. So if you were to buy shares of this fund, it would cost you $265.10 per share. And one thing to keep in mind, just like stocks, you can't compare two mutual funds based on their NAV any more than you can compare two stocks just based on their stock price. That by itself is meaningless, but it will help you to understand what the current price of the mutual fund is. And it also, as you can see, shows you the one-day return. So how much the fund, the price changed effectively over the last trading day. And so that's what that shows you. And then total assets, you can see here, it's in billions, $496 billion. Certainly for index funds, you're going to have funds that are quite large generally, unless they track a rather obscure index. But so for something like a Vanguard S&P 500 index fund, the assets are going to be quite large. In and of itself, not highly relevant. Where it can matter is that larger funds can spread out the costs of running the fund over more assets, thereby bringing down the expense ratio. And funds that maybe are just starting and don't have as many assets under management, their expense ratios can be a bit higher. But you're not going to want to evaluate that really based on total assets. You're really going to want to go right to the source, and that is the expense ratio itself. And that brings us to the next two items here on the screen. You'll see an adjusted expense ratio and an expense ratio. Now, as you can tell, in the case of this mutual fund, they're the same. They're 4 basis points, 0.04%. That is extremely low. And one of the reasons that so many folks, myself included, favor mutual funds from Vanguard. They're very, very inexpensive. And it's often the case, in my experience, particularly with index funds, that the adjusted expense ratio and the expense ratio are the same. I suppose you may be evaluating some funds where they're different, and just understand that the adjusted expense ratio excludes certain variable investment related expenses. For example, if the fund borrows and to invest with leverage and interest, for example. And if you hover over the little information icon here, you'll see a definition of it. For the most part, I'm focused on the expense ratio. I don't know that I invest in any mutual funds where the adjusted expense ratio is different, but certainly if you're evaluating a fund and it is different, you'll want to do your best to understand why. Fee level is just Morningstar's assessment of how the fees of a given mutual fund compare to the industry as a whole. As you can tell here, 4 basis points is extremely low, and that's reflected in the fee level. Now, a load is also potentially a part of the fees of a mutual fund. As you can see, this fund doesn't charge any. But you can really think of loads in 2 ways. There's what's called a front-end load, which is a sales charge. It's a fee that you pay each time you invest money into the mutual fund. They can also have what are called deferred loads, which are, think of them as redemption fees. So you may not pay anything to invest in the fund, but when you want to sell your shares, then you have to pay a fee. Again, this Vanguard index fund doesn't have loads, but some funds do. And in fact, we can pull up one. I don't know the ticker, but I know that American funds charge loads. And in fact, here's an example. And you'll notice this letter A right here in the name of the fund. That means it's A shares, and A shares have these front loads. And you can see it here, 5.75%, which means for every $100 you invest in this fund, you'll pay $5.75 of that money as fees to the mutual fund company. And that's going to come up in other ways, particularly when we look at the performance of a fund. And so we'll come back to that. So keep that idea of a load or a sales charge, a front-end load in mind. Now, the other thing I want to point out here, remember we just looked at the Vanguard fund. It had an expense ratio of 4 basis points. Well, this fund has an expense ratio of 69 basis points. Remember, 100 basis points would be 1%. So this one is 0.69%. The thing I point out is Morningstar calls this low as well. The 4 basis points from Vanguard they called low. The 69 basis points from this American fund they call low. And let's even put aside the load fee. And it can tell you that Morningstar's assessment of the fee level in and of itself may not always be that helpful, because I can tell you, all other things being equal, there is a huge difference between a fund that charges 69 basis points versus one that charges 4 basis points. I mean, over a lifetime of investing, you can easily be talking about tens of thousands and probably more like hundreds of thousands of dollars if you're a long-term investor. So it's a huge difference. And to categorize them both as low, I think, is not all that helpful. And it just, I think, makes the point that you need to understand how Morningstar is categorizing things and really focus on the actual data so that you can make your own assessment. Take Morningstar's evaluation, that's fine. It may be useful, but do your own thinking and your own analysis. And here you'd want to understand, okay, 69 basis points, and put that in context with, for example, low-cost index funds. All right, going back to Vanguard. The next 2 things are related, and I'm actually going to talk about them in more detail in the next video because I think they're important and in and of themselves worth focusing on in a full episode. But it's the category and the investment style. And you may have come across Morningstar's investment style box that you see here. It looks like a tic-tac-toe board. This categorizes the fund, and this is a Morningstar categorization. In the case of this Vanguard 500 fund, what Morningstar is saying is it's a U.S. fund, and it invests in large companies and it's a blend. Now, I'm going to go, like I said, I'm going to go into more detail in the next video on all of this. So won't spend a lot of time on it now. The box takes all of this information and gives you a visual representation of it. It can be very useful, and we'll cover it in the next video. The minimum initial investment, it tells you just how much you have to invest to get started. In this case, it's $3,000, which is very a common minimum investment for Vanguard funds. There are some that are $1,000. And of course, at other mutual fund companies, there may be no minimum investment. For example, with Fidelity, a lot of their funds, you can invest with as little as you'd like to get started. Status tells you whether the fund is still accepting new investors. There are some funds that eventually close to new investors. This fund is open. The SEC yield, as you can see, is 2.21%. That's looking at the amount of dividends and income that this fund generates as compared to its net asset value. And as you can see, it's 2.21%. The reason they call it an SEC yield is that the SEC has a specific formula that is used for calculating yield, and that's what's being used here. And but this gives you an idea of the dividends and interest a fund generates. In the case of the Vanguard 500 Index Fund, since it's a mutual fund that holds stocks, equities, it's going to be the yield is going to be generated from dividends. Okay, and then the last one in this first section of the page, turnover, is in this case 4%. That's an important number. And turnover basically means effectively what percentage of the assets have changed over the past year. There can be funds where the turnover is 100% or more. Now that doesn't mean they literally sold every investment held by the fund, but in terms of value, they've sold the equivalent of 100% of the assets. So if the fund holds $100 million in assets, it may have sold just 20 million in assets, but maybe it sold them and then sold them again and then sold them again and bought something else and did it over and over and over again. You could end up with a turnover of 100%. Why does this matter? Well, it matters for at least two reasons. The first is that this turnover requires funds to, of course, buy and sell stocks or bonds, whatever they're investing in, and they incur transaction costs from doing that. And those transaction costs are not covered in the expense ratio. They're separate. So a mutual fund with a high turnover percent is going to incur, all other things being equal, more costs than a fund like this Vanguard fund with relatively, or really extremely low turnover. The second thing is that if you're holding the investment in a taxable account, a lot of buying and selling by the mutual fund company doesn't necessarily mean it will, but it can trigger taxes. Those taxes, depending on how they manage it, funds tend to try to manage the tax liabilities by, for example, if they're going to sell one asset at a gain, try to find another asset that's got losses that they can sell to offset it. But that's not always possible. And so if you are looking at a mutual fund or an ETF with a high turnover rate, you really want to think about the tax implications if you're holding this in a taxable account. There's more data on Morningstar that gives us greater insight into the tax efficiency of a fund, and we'll be looking at that later in the series. So that's what that first section of the quote page shows us. Now, before we move further down the page, I want to look at this same section, but for an ETF. There's a few differences. So here I'm showing it's effectively the exact same fund, but it's an ETF. And the ticker is VOO, and it's Vanguard's S&P 500 ETF. And there are a couple of differences. One that sort of jumps out at us is this chart here that actually shows the price movement of this ETF throughout the trading day. I'm recording this towards the end of the market. It hasn't closed yet, and you can actually see it here. It's just after 2:15 as I record this video, and you can see how the price has fluctuated throughout the day. And its current price is 263.38, up just slightly from the last close. Looks like, well, maybe, nope, open price 264.71. Here's the key takeaway. When we come back to the mutual fund, there's no chart. There's no daily movement in the fund price. Why is that? The answer is that ETFs trade just like stocks do. They're trading throughout the trading day, and the price is going to fluctuate accordingly. When you buy and sell an ETF, just like a stock of a company, you're entering into a transaction with another investor. With a mutual fund, you're not. Typically, with a mutual fund, when you buy shares, you're buying directly from the mutual fund company. And the price that you're going to pay gets set at the end of each market close. So this NAV that you see here will change based on today's market, but it won't change until the market is closed and Vanguard can recalculate the value of all of the assets held by the fund divided by the number of shares. And tomorrow, when we come back to this page, we'll see a new net asset value, assuming that it changed. We'll see a new net asset value for this mutual fund. But it just gets reset once each market day, and it's after the close of the market. ETFs, as you can see, trade throughout the day, and the markets, as you can see from this chart, fluctuate throughout the day. For the vast majority of long-term buy and hold investors, there's simply no need to own an ETF. They effectively, in this case, comparing the mutual fund and the ETF, they're effectively the same thing in terms of the investments that they hold and their long-term performance, as we'll see in a minute. But there's just no need generally to hold an ETF for long-term buy and hold investors. But if that's nevertheless something you want to focus on, that's probably the biggest difference. Now, you can see some other data, and this is again because it trades like a stock. So you're seeing the bid and ask and the spread. That is what people are willing to pay for the shares of this ETF, what people are willing to take if they're trying to sell shares. You can see the spread is it's insignificant, 0.01% based on this data. And the reason is because this is a highly traded ETF. You can see the average volume, 2 million here and 8.6 million. It's a highly traded ETF. So it's going to, the bid-ask spread is going to be very small, and the fund is going to trade very near its net asset value. Now, however, not all ETFs can say the same thing. Not all ETFs have the kind of trading volume that a Vanguard S&P 500 ETF would have. So if you're looking at ETFs, you want to understand the volume. The reason is ETFs can trade at a notable premium or discount to its net asset value. And so in buying an ETF, that's something you're going to want to consider. And here you might be saying, boy, Rob, that seems like a lot of complexity. Well, it can be, which is just another reason why I don't think buy and hold long-term investors need to bother with ETFs. I would stick with mutual funds, and that's what I do. But moving on, you can see the day and year range, just like you would a stock. You can see the expense ratio, which you'll notice is 1 basis point lower than the expense ratio for the Vanguard 500 index fund. They're, not particularly significant, but a basis point is a basis point. And other than that, those are the main differences that you'll see in this top section for an ETF. Now, I want to go down to the Morningstar Analysis, and actually for this, I'll jump back to the mutual fund. This is one area where premium membership makes a difference. You can only read the full analysis here if you're a premium member. Now, it's something that I will confess I've never read a Morningstar analysis of a fund. That's not a reflection on Morningstar at all. It's just there's simply no need to. I'm primarily a buy and hold index fund investor, and there's just no need to read an analysis of, say, an S&P 500 index fund. I can evaluate it myself and understand what it invests in, understand its expenses as I'm walking through with you. So I just don't read the analysis of Morningstar, and that's true even of individual stocks that I invest in. However, if that's something that you're interested in, then you would need to be a premium member to see all of the analysis. So now let's move to performance. And again, keep in mind, this is just a snapshot. In future videos, we'll be looking at performance in more detail. But what Morningstar does, as you can see, is offer a chart that shows the growth of 10,000. What does that mean? Well, the idea is if you invested $10,000 10 years ago, what would it be worth today? And how does that compare to the fund's index, the closest index that it tracks, as well as the category? Now, the category is something that Morningstar defines. And as you can see up here, the category is U.S. Fund Large Blend. And so when we look at the Vanguard 500 Index Fund, we can see that the fund is a blue line and the index is a red line. And if you're looking at the chart, you may be scratching your head and saying, well, Rob, where's the blue line? I just see red and yellow. Well, the blue line is under the red line. It's hard to see, but it's there. And you can tell that they pretty much track exactly, for all practical purposes. And you would expect that because this is an S&P 500 index fund with extremely low expenses. So you would expect it to track the index very closely. And in fact, over a 10-year period, the difference in value actually is just a few dollars. And actually, as I look at it now, the Vanguard fund has outperformed the index by, about $70. I frankly could try to figure out why, but I never have. But as you can tell, it tracks the index very closely. On the other hand, it's outperformed Vanguard's category, which, by the way, is going to include actively managed funds. So as compared to the category of U.S. large blend companies, this S&P 500 index has done quite well. Just another reason why I think, or an example of how index funds over the long term generally outperform the vast majority of actively managed funds. Now, you can see they indicate if there's been manager changes. We're going to look at people, which is actually a category of information that Morningstar shows you for mutual fund. However, in the case of an index fund, the folks that manage it aren't actually as important because they're not actually making meaningful investment decisions. They're just tracking an S&P 500 index fund. On the other hand, if you're considering an actively managed fund where the managers are doing their own analysis and picking and choosing which stocks and bonds to invest in, then who the managers are and any management changes can be extremely important. And this just gives you a snapshot of any changes that may have occurred over the last 10 years. Again, in a future video, we'll look at that in more detail. Now, when we get down to total returns, and actually, before we do, real quick, the fund flows just show the net flows in or out of the fund. And as you can see, for the most part, there have been more funds going into, more dollars going into this fund than have been coming out, except recently when, of course, we've had a pretty difficult market because of COVID-19. So the last section that we see here is the total return section, and it's by year. And what they do, and this is confusing. So what they do, they first show the fund's return, and that's assuming the reinvestment of all dividends and interest. Now that's simple enough. But then they compare it to the category. Now, let's stop there for just a second. The category, again, is a Morningstar determination. Again, this is part of the U.S. equities large blend fund, so that's what they're comparing it to. And positive numbers here mean that, in this case, the Vanguard fund outperformed the category. And I'm looking to see if it ever underperformed, at least in the last 10 years. It did not. What gets confusing is this plus or minus index. Remember, we looked at the lines up here and they matched almost perfectly. In fact, you can't even really see the blue fund line because it's right underneath the red index line. But when we come down to this index row, we see some big differences. It's off by 1%. It's outperformed the index by almost 60 basis points, underperformed, overperformed, and so on. There's a few years that it's really close, but plenty of years where it was notably different. Why don't we see that reflected in the chart? And the answer is the chart index, at least based on the documentation that Morningstar provides, and based on the fact that the index and the fund are almost identical, is the S&P 500 index fund, which is, I think, what you would expect Morningstar to compare this fund to, since that's the index it tracks. Down here, unfortunately, they use a different index. You can see here, they use the Russell 1000. There's actually a Russell 3000, and then it gets divided between 1000 and 2000. 1000 being effectively the 1000 largest U.S. companies, which of course includes the S&P 500 for the most part. But it's of course different. It includes smaller companies as well. And that's what Morningstar has decided to compare this fund to down here in this index. The real takeaway here is that you'll want to spend some time, if these numbers are important to you in your analysis of an investment, to understand how Morningstar is coming up with these comparisons. And so I guess the takeaway is you got to read the fine print. I find a comparison of this mutual fund to the Russell 1000 to be pretty irrelevant. All right, having said that, let's move on. They show you how this fund compares to other funds. Here, the smaller the number, the better. So you want to a ranking of 1 would be at the top, a ranking of 100 would be at the bottom. And these little icons are just a visual representation. So anything, say 25 and below, is going to be the top bar, and this is an example. 24, 17 is another example. Anything between, say, 26 and 50 is going to be the second bar, and you can see 29, there's an example, 35 and 42. If there were numbers below 50, you'd see the third, and then below 75, the fourth line in black. But in this case, the Vanguard fund has always done better, at least than the bottom two quartiles. So this just gives you a very quick analysis of, or comparison of, this fund with other funds. And here, the bottom row, it tells you how many funds are in the comparison. One thing that I found interesting is that the number of funds in this category has come down significantly since 2010. So having looked at that, I just want to make a quick comparison. Let me move this over and look at a comparison of the S&P 500 mutual fund on the left from Vanguard and the S&P 500 ETF on the right. And you can see the ETF doesn't go back in time as far. So you really, for comparison's sake, probably start in 2012. But if you go year to year, you can see that there are some differences, but by and large, long term, the performance is, for all practical purposes, the same. Again, I don't see a need for most folks to invest in ETFs, but I wanted to show you that even when you're dealing with the same underlying investments, the performance of a mutual fund and its ETF equivalent can be a little different from year to year. The differences are usually not dramatic. Okay, so that gives you sort of an overview of this quote page. And as I said, you can get a very good snapshot of a mutual fund or ETF very quickly from this page. This is also the page that you'll come to whenever you search for a mutual fund, an ETF, or a stock. Now, what we're going to do in the next video, as I mentioned earlier, is we're going to cover what this category really means and this investment style box, both when evaluating a stock mutual fund and when you're evaluating a bond mutual fund, because the analysis is and the investment style box are different. They show different information. So that's what we're going to cover in the next video. As always, feel free to shoot me an email, rob@robberger.com, and Leave comments below the video. I will be monitoring those and happy to provide any further information that could be helpful to you. Until next time, remember, the best thing money can buy is financial freedom.